I bought this stock, and 3 days later, it jumped 25%. That sounds like a win, but it left me with an honest question. Did I spot the value early, or did I miss it, and the run's already happened? The company is B&M. A year ago, it had lost half its value, and the yield had climbed towards 6%. Then the results landed, and the shares jumped. So here's the one question that settles it. Is the dividend safe? And is there still value left at today's price? Here's the part the headlines skipped right past. Through the whole collapse, the dividend was never cut. Not reduced, not even paused. Management just kept paying it. So this was never really a story about a broken company. It was about a cheap one, and whether cheap meant a bargain or a warning. Quick one before we go further. This isn't investment advice. I'm documenting my own investing journey, nothing more. Always do your own research before you put money into the market. A stock that's halved carries real risk. It can keep falling. It can also be where the value is. Today is about working out which. So let me set the scene. B&M is a UK value retailer, nearly 900 shops here, plus a smaller chain in France. The model is about as simple as retail gets. Buy up surplus and end-of-line stock in bulk. Stack it high, sell it cheap. You walk out with brand name goods well below the supermarket price, and B&M keeps the margin on the deal. It's the same engine that built TJX, the American giant behind TK Maxx, and for years the market loved it. During the cost of living squeeze, B&M was a quiet winner. Shoppers traded down, sales grew, and the shares ran all the way past £3.50. The company even handed out special dividends on top of the normal ones. Then, around the middle of last year, the mood turned. The share price slid for months, all the way down to about £1.40. That's where I started paying attention, because a falling price on a steady dividend means a rising yield. And a rising yield is the sound that pulls income investors in. But a high yield on a falling stock is a trap as often as it's a gift. So before the bull case, here's what the people selling it see. 3 worries, and each one deserves a straight answer. Start with the big one, spending. B&M's whole rise was built on the trade down. When money got tight, shoppers swapped the supermarket for the discounter, and the tills rang. But that engine runs both ways. As inflation eases and budgets loosen, some of those shoppers drift back up the high street, and B&M takes the rare double hit. Fewer visits and a smaller basket from the ones who stay. Sales growth has already cooled from double digits to roughly flat. That's the worry that actually matters, because it questions the engine, not just one bad quarter. The second's simpler, it's margins. Wages and energy cost more than they did, so profit gets squeezed even where sales hold up. And the third is the re-rating. For years, the market paid a growth premium for B&M. When the growth cooled, that premium had to come out of the price. So a lot of this fall isn't the business breaking, it's the market deciding what it's now willing to pay. So with all that hanging over it, why did the shares jump 25% in 3 days? Because the full year results were simply better than the gloom priced in. Profit held up better than feared. The company kept investing in new stores. And the dividend, the number this whole case rests on, was confirmed, not cut. For months, the market had been bracing for bad news. The results said, not this bad. And a stock price for disaster only needs not a disaster to move. That jump wasn't the story ending. The market was finally starting to come round to the income investors who kept buying while everyone else worried. A short break, then straight back to it. This channel follows a real UK dividend portfolio, month by month, from the very first pound. The wins and the calls that don't work out. If that's the kind of investing you're building yourself, come along for it. Subscribe and you'll see exactly how this B&M call plays out. And one honest note while we're paused. The platform you see in every screenshot here is Trading 212. It's where I hold my stocks and shares ISA. No trading fees and fractional shares, so you can start with any amount. The link down in the description is a referral link, so let me be straight with you about how it works. If you sign up through it and fund an account, we each get a free fractional share, worth up to £100. And yes, I earn that reward too. So only use it if the platform genuinely suits you. This isn't advice, and your capital's at risk when you invest. Right, back to the case. So the results handed round one to the income investors, the quiet buyers the sellers had been betting against. But one good day doesn't win the argument. Does the case still stand at today's price? What those buyers see comes down to two numbers. The ones that decide whether the income is real start where the sellers are most afraid. The dividend itself. Strip away every worry and the bear case ends in one nightmare. The payment gets cut. So can the company actually afford to keep paying? Last year's earnings covered the payout roughly twice over. Twice! That's real headroom. Profits could fall hard from here. A fifth, even a quarter, and the dividend still gets paid out of the cash the business throws off, without touching the balance sheet. The stocks that cut in a downturn are the ones running on cover near 1. B and M isn't close to that line. Then there's what you actually get paid to wait. When I bought in, the yield was just under 6%. After the bounce, it settled around 5%. The price went up, so the yield came down. That's the whole trade-off in one number. But put that 5% in real terms. That's around £50 a year for every 1,000 you hold, landing in your account, while the rest of the market makes its mind up. The FTSE 100 average is closer to 3.5, so you're paid a clear premium just to be patient, out of a dividend that, remember, is covered twice over. And the income side has one more edge. Even after the bounce, the price still hasn't caught up to the business. The shares trade at around 9 times earnings. The broad UK market sits nearer 14, so the market is still pricing B and M as if the sellers were right, at a discount to the average company, even after the results suggested they weren't. Meanwhile, the business keeps doing the unglamorous thing that matters, still opening new shops, roughly one a fortnight, with the French arm growing too. This isn't a company in retreat, it's a growing one the market hasn't forgiven yet. It helps to put that income in company. Tesco pays you around 3%, Sainsbury's a fair bit more, just over 4%, Marks & Spencer only about 1%. So at today's price, B and M out-yields every one of them. And it's covered better than most too. Some of that yield is a reward for the risk, no question. But some of it is just a good business the market hasn't fully forgiven yet. So where do I land? Oh, for me, the results answered the one question that actually mattered: is the dividend safe? And the answer for now is yes. That's why I'm holding, and why I'd still add on weakness rather than chase the bounce. Do I wish I'd bought even cheaper? Of course, but the income case never depended on me timing the bottom. It depended on the dividend holding and the cover staying healthy. Both are intact. The honest risk is that spending gets worse from here and next year's profits slip. That's real, and it's why this is a measured position for me, not a heavy one. So here's the whole case on one card. What's it paying? About 5%. A clear premium to the market. Is that a fair price? More than fair, around 9 times earnings, when the market sits nearer 14. Can it keep paying? Comfortably, covered roughly twice over. And that cover is the one number I actually watch, because the morning that dividend is ever cut, the whole reason for owning this is gone, and I'm out the same day. Has it kept paying? It held right through a 50% fall, never cut, not even trimmed. And why does it pay? Because underneath the share price, it's a simple cash-generative business that's still opening shops. So, would you buy it at this price? That's the case laid out. The buy call at today's price is yours to make. But if you want to follow how it actually plays out, payment by payment, subscribe and come along. And drop your verdict below, value buy or value trap. Until next time, happy investing. Happy